All right, today we're going to demystify something that can feel, a little overwhelming, a company's financial report. We are going to break it down and show you how to read these things like an absolute pro.
You know that feeling, right? You open up an annual report and it's just pages and pages of numbers and jargon. Your eyes just start to glaze over. It feels like you're trying to read a foreign language. But what if I told you it's actually way simpler than it looks? Here's the secret. You just have to change how you look at it. This isn't some dense, boring accounting document. No. Think of it as a company's annual health report. It's a full medical checkup that shows you everything about its health and its performance. Okay, let's dive.
So first, let's really lean into this idea, thinking of this report as a company's complete health assessment.
I mean, think about it. When you go for a checkup, a good doctor doesn't just take your temperature and call it a day, right? Of course not. They check your blood pressure, your heart rate, your history. They look at how all your systems are working together. A financial report does exactly that for a business. It tells a rich story about its financial well-being, its strengths, and its weaknesses too.
And every health check starts with the basics, the vital signs. For a company, there are three main ones you absolutely have to know.
First up is the balance sheet. And the most important word here truly is snapshot. Imagine someone hitting the pause button on the entire company at a single moment in time, like midnight on December 31st, and taking a picture. That's the balance sheet. It just shows you the final score on that one particular day.
And it all boils down to one simple, beautiful equation. Assets equal liabilities plus equity. In plain English, all the stuff the company owns, like its cash, its buildings, its inventory, has to be paid for by one of two things. Either money it owes to someone else, that's the liabilities, or money the owners invested themselves, that's the equity. It all has to balance out, hence the name.
So if the balance sheet is the snapshot, our second vital sign, the income statement, is the complete opposite. It's the video. It shows you all the action over a whole stretch of time, say an entire year. It tracks all the money flowing in as revenue and all the money flowing out as expenses. And what's left at the end? The bottom line. Did they actually make a profit or did they take a loss?
So just think of it like this. The balance sheet is a single photo capturing one moment. The income statement is the movie of the whole year. You absolutely need to look at both to get the full picture.
And our third and final vital sign is the statement of cash flows. Now listen, profit is great, but cash is king. Cash is the absolute lifeblood of a company. A business can look profitable on paper but go bankrupt because it ran out of actual cash. So this statement is crucial. It follows the money, tracking where cash came from and where it actually went.
And this statement neatly organizes everything into three simple buckets. First, operating activities. This is cash from the main day-to-day business. Second, investing. This is cash spent on or made from big-ticket items like buying a new factory or selling off old equipment. And third, financing. This is cash from taking out loans, paying them back, or dealing with investors.
Okay, so we've got our vital signs. We have the numbers from the balance sheet, the income statement, and cash flows. Now for the fun part. How do we actually make a diagnosis?
And this really is the million-dollar question, isn't it? A company earned $1 million in profit. So what? Is that good? Is it bad? A debt of $5 million might sound scary, but is it? You see, the numbers by themselves are almost meaningless. The answer and the key to everything is context. And you get that context from one simple thing, comparison. For example, let's say company X has a 12% profit margin. Is that good? Who knows? But the second we see that the average for their industry is 15%, boom, all of a sudden we have a critical piece of insight. They're actually underperforming their peers. Now we have a real starting point for our investigation.
To make these comparisons, analysts use these simple little calculations called financial ratios. They're like specific diagnostic tests. You have profitability ratios to see how good they are at turning sales into profit. You have liquidity ratios to answer a vital question. Can they pay their bills next month? Then there are solvency ratios, which ask a bigger question. Is the company stable enough to survive a recession? And finally, growth ratios, which, you guessed it, measure how fast the company is getting bigger.
So when you put all this together, how does it give you an edge? Let's talk about the advantage this gives you.
It all comes back to telling a story.
As the author John J. Tracy puts it, it's only when you understand the context that you can really interpret the statements and get a sense of a company's future. The numbers themselves are just chapter 1.
So here is your final prescription, your game plan for reading any report. Number 1, look for trends. Is the patient getting healthier or sicker over the last few years? Number 2, compare them to their peers. How do they stack up against the competition? And number 3, always keep a skeptical eye. Look for red flags or weird accounting. This is how you go from just reading numbers to making truly informed decisions.
So the next time you open a financial report, don't get intimidated. See it for what it really is, a story waiting to be told, a story of success, of struggle, of strategy, and of opportunity. You now have the tools to read it. So the only question left is, what story will you uncover next?